Question 1. Which of the following is the primary characteristic of a fixed annuity? A. The value of the annuity fluctuates based on market performance. B. It provides a guaranteed income for a fixed period or life. C. It offers flexible premium payments based on the investor's risk appetite. D. It has no restrictions on the payout phase. Answer: B. It provides a guaranteed income for a fixed period or life. Explanation: a fixed annuity offers a guaranteed income stream to the annuitant, either for a fixed period or for the annuitant's lifetime, regardless of market conditions. The insurer assumes the investment risk. The other options describe characteristics of other types of annuities, such as variable annuities, which have market-based returns, or flexible premium products, which allow for adjustments in premium payments. Fixed annuities are considered more stable compared to their variable counterparts because the income amount does not fluctuate with market performance. Question 2 scenario: Mr. Carter, a 65-year-old retiree, is considering purchasing an annuity as a way to secure a reliable income for his retirement. He is looking at a deferred annuity product with a 10-year accumulation phase and a 15-year distribution phase. Which of the following would be the most important consideration for Mr. Carter before purchasing the annuity? A. The tax implications during the accumulation phase. B. The guaranteed rate of return on the annuity. C. The liquidity options available during the accumulation phase. D. Whether the annuity has a living benefits rider. Answer: C. The liquidity options available during the accumulation phase. Explanation: given Mr. Carter's retirement status, liquidity is a critical factor when purchasing an annuity. A deferred annuity may lock up his funds for a significant period before the distribution phase begins, and he may need access to those funds before the annuity starts paying out. Understanding the surrender charges and early withdrawal penalties that apply during the accumulation phase is vital. The other options are important, but liquidity is particularly critical in the context of retirement planning when access to funds may be necessary. A guaranteed rate of return, B, and living benefits, D, are relevant but secondary to liquidity for someone in Mr. Carter's situation. Question 3. Which of the following payout options provides income for a specified period but stops once the period ends, regardless of the annuitant's survival? A. Life-only annuity. B. Joint and survivor annuity. C. Period certain annuity. D. Lump sum payment. Answer: C. Period certain annuity. Explanation: a period certain annuity pays income for a specified period, such as 10, 20, or 30 years. If the annuitant dies before the period ends, the remaining payments continue to the beneficiary for the remainder of the period. However, if the annuitant survives the period, the payments cease. A life-only annuity A guarantees payments for the annuitant's lifetime, while a joint and survivor annuity B continues payments after the annuitant's death, often to a spouse or other beneficiary. A lump sum payment D provides the entire annuity value as a one-time payment rather than periodic payouts. Question 4. Which of the following best describes the tax treatment of annuities during the accumulation phase? A. The interest earned on the annuity is subject to capital gains tax. B. The interest earned is tax deferred until withdrawal. C. The interest earned is taxed annually. D. The principal is taxed annually while the interest is tax deferred. Answer: B. The interest earned is tax deferred until withdrawal. Explanation: in annuities, the growth of the account value is tax deferred during the accumulation phase. This means the annuity holder will not owe taxes on the interest or investment gains until they start receiving distributions, typically in the payout phase. The interest earned is not subject to capital gains tax A or annual taxation C during the accumulation phase. The principal itself is not taxed annually D until the distribution phase begins. Question 5. Which of the following factors most influences the payout amount of a variable annuity? A. The fixed interest rate set by the insurance company. B. The performance of the underlying investment options chosen. C. The length of the distribution phase. D. The total amount of premiums paid into the annuity. Answer: B. The performance of the underlying investment options chosen. Explanation: a variable annuity's payout amount is directly tied to the performance of the investment options chosen by the annuitant, such as stocks, bonds, or mutual funds. The more the investments grow, the higher the payouts, although there is also a risk of loss if the investments perform poorly. The fixed interest rate A does not apply to variable annuities, and while the length of the distribution phase C and the total premiums paid D may influence the total payout over time, the performance of the investments is the most significant factor. Question 6. Scenario: Mrs. Thompson is 75 years old and is considering purchasing an immediate annuity to provide a steady income stream for the remainder of her life. Which of the following options should she consider to ensure her annuity payments continue if she passes away early in the contract? A. Choose a joint and survivor annuity. B. Select a period certain annuity with a 10-year payout. C. Opt for a life-only annuity with no additional features. D. Choose a lump sum payout option. Answer: B. Select a period certain annuity with a 10-year payout. Explanation: a period certain annuity ensures that the annuity payments continue for a specified period, regardless of whether the annuitant survives that period. If Mrs. Thompson passes away before the 10-year period ends, her beneficiary would continue to receive the payments for the remaining term. A joint and survivor annuity is a better option for couples as it provides payments to a surviving spouse. A life-only annuity C stops paying once the annuitant dies, so it does not provide protection for beneficiaries. A lump sum payout D would not provide ongoing payments, making it unsuitable for her needs. Question 7. In South Dakota, what is the primary regulatory body overseeing the sale and administration of annuities? A. South Dakota Department of Revenue. B. South Dakota Department of Insurance. C. South Dakota Securities Commission. D. South Dakota Financial Services Authority. Answer: B. South Dakota Department of Insurance. Explanation: the South Dakota Department of Insurance is the primary regulatory body overseeing insurance products, including annuities, within the state. It ensures that insurance companies comply with state laws, consumer protections, and financial regulations. The Department of Revenue handles taxes, not insurance regulations. The South Dakota Securities Commission (C) oversees securities but does not regulate insurance products directly. The South Dakota Financial Services Authority (D) is not a regulatory body specific to annuities in the state. Question 8. What is the primary risk associated with purchasing a fixed annuity? A. Inflation risk, as the fixed payments may not keep up with rising prices. B. Market volatility risk, as the value of the annuity is tied to market performance. C. Interest rate risk, as low interest rates may limit the growth of the annuity. D. Liquidity risk, as early withdrawal fees may apply. Answer: A. Inflation risk, as the fixed payments may not keep up with rising prices. Explanation: the primary risk associated with fixed annuities is inflation risk, as the fixed payout amount may lose purchasing power over time if inflation rises. Fixed annuities offer guaranteed income, but the payments typically do not adjust to account for inflation. Market volatility risk B is more relevant to variable annuities, which are linked to market performance. Interest rate risk C and liquidity risk D are also concerns, but inflation risk is the most pressing for fixed annuity holders, especially over long periods. Question 9. Which of the following is a characteristic of an indexed annuity? A. The annuity's returns are based on a fixed interest rate. B. The annuity is directly tied to the performance of a specific stock or bond portfolio. C. The annuity returns are linked to the performance of a market index with limits on gains. D. The annuity offers a guaranteed return regardless of market conditions. Answer: C. The annuity returns are linked to the performance of a market index with limits on gains. Explanation: indexed annuities link their returns to the performance of a market index, such as the S&P 500, but typically include caps, participation rates, or spreads that limit the potential gains. These limits protect the insurer from extreme volatility, unlike variable annuities B, which invest directly in markets. Indexed annuities provide a fixed income floor while limiting the maximum possible gain. Fixed interest rate annuities A do not fluctuate with market performance, and guaranteed returns D are characteristic of fixed annuities, not indexed ones. Question 10. Which of the following annuity riders provides a benefit to the annuitant in the event of a long-term care need? A. Living benefits rider. B. Guarantee minimum income rider. C. Long-term care rider. D. Death benefit rider. Answer: C. Long-term care rider. Explanation: a long-term care rider allows the annuity holder to access funds from the annuity to cover long-term care expenses, typically at a reduced payout rate if the annuitant becomes ill or disabled. This rider helps provide additional financial support in case the annuitant needs nursing home care or other long-term care services. A living benefits rider A provides access to benefits in case of terminal illness or death, while a guaranteed minimum income rider B ensures a minimum level of income. A death benefit rider D provides a benefit to the annuitant's beneficiaries, but not for long-term care needs. Question 11. Which of the following statements best describes a joint and survivor annuity? A. It provides income payments for a fixed period regardless of the annuitant's lifespan. B. It provides lifetime income to both the annuitant and their spouse or partner. C. It guarantees payments to a beneficiary for 10 years. D. It offers a lump sum payout to the annuitant's beneficiary upon their death. Answer: B. It provides lifetime income to both the annuitant and their spouse or partner. Explanation: a joint and survivor annuity provides lifetime income to both the annuitant and their spouse or partner. Payments continue to the surviving partner after the annuitant passes away. It ensures that the surviving spouse will not outlive their income. The other options, A, C, D, do not reflect the nature of joint and survivor annuities. Question 12. What is the primary advantage of purchasing an annuity with a cost of living adjustment COLA rider? A. The annuity payments increase based on the performance of the market. B. The annuity payments increase with inflation, preserving purchasing power. C. The annuity payments will be guaranteed even in the event of market downturns. D. The annuity payments will be exempt from taxes. Answer: B. The annuity payments increase with inflation, preserving purchasing power. Explanation: a cost of living adjustment COLA rider ensures that the annuity payments increase periodically, typically in line with inflation. This helps preserve the purchasing power of the annuitant's income over time. The other options, A, C, D, do not describe the key feature of the COLA rider. Question 13 scenario. Mr. Williams purchased a variable annuity with a death benefit rider that guarantees his beneficiary will receive a minimum payout of $100,000 upon his death. At the time of his death, the annuity's value is $90,000. Which of the following will happen? A. The beneficiary will receive $90,000. B. The beneficiary will receive $100,000. C. The beneficiary will receive the difference between the $100,000 death benefit and the $90,000 value. D. The annuity will be cancelled and no payout will be made. Answer: B. The beneficiary will receive $100,000. Explanation: with a death benefit rider that guarantees a minimum payout, the beneficiary will receive the greater of the annuity's current value or the guaranteed amount. In this case, the $100,000 guaranteed death benefit exceeds the $90,000 value, so the beneficiary will receive $100,000. Question 14. Which of the following is a characteristic of a fixed annuity? A. It provides returns based on the performance of the financial markets. B. It offers a guaranteed interest rate for a specified period. C. It allows for unlimited withdrawal options. D. It has a variable payout based on investment performance. Answer: B. It offers a guaranteed interest rate for a specified period. Explanation: a fixed annuity provides a guaranteed interest rate for a set period, offering predictable, stable returns. The other options, A, C, D, describe characteristics of variable annuities or do not apply to fixed annuities. Question 15. Which of the following is not typically a feature of a variable annuity? A. Investment options linked to equity or bond markets. B. The ability to allocate premiums among a variety of sub-accounts. C. Guaranteed income regardless of investment performance. D. Risk of loss based on the performance of the underlying investments. Answer: C. Guaranteed income regardless of investment performance. Explanation: variable annuities do not guarantee income regardless of investment performance. The annuities payouts are based on the performance of the underlying investments, so there is the risk of loss. Options A, B, and D are all characteristics of variable annuities. Question 16 scenario. MS. Parker purchases a fixed annuity that pays her $1,000 per month for 20 years. After 10 years, she passes away unexpectedly. What happens to the remaining payments? A. The payments will continue for the remainder of the 20 years to her beneficiary. B. The payments stop and no benefits are paid to her beneficiary. C. The insurance company will refund the premiums she paid into the annuity. D. The payments will stop, but the insurance company will pay a lump sum to her beneficiary. Answer: A. The payments will continue for the remainder of the 20 years to her beneficiary. Explanation: in the case of a fixed annuity with a period certain feature, payments will continue to the beneficiary for the remaining term of the contract. The other options, B, C, D, do not apply to this scenario. Question 17. Which of the following would likely be an advantage of choosing a deferred annuity? A. Immediate access to funds in case of emergency. B. Tax-deferred growth of the annuity's value until withdrawals begin. C. Guaranteed payments immediately upon purchase. D. Higher annual payouts than a fixed annuity. Answer B. Tax-deferred growth of the annuity's value until withdrawals begin. Explanation: a deferred annuity allows the funds to grow tax-deferred during the accumulation phase. This means the annuity's interest earnings will not be taxed until they are withdrawn. Deferred annuities do not provide immediate payouts, say C, or necessarily higher payouts, D, compared to fixed annuities. Question 18. What is the primary benefit of a rider on an annuity? A. It offers additional benefits or protections outside of the standard annuity contract. B. It increases the annuity's investment options. C. It guarantees a higher payout for the annuitant. D. It provides a tax break on the annuity's earnings. Answer A. It offers additional benefits or protections outside of the standard annuity contract. Explanation: a rider is an additional feature that can be added to an annuity contract, providing extra benefits or protections such as a long-term care rider, death benefit rider, or cost of living adjustment rider. Riders do not directly affect the investment options. B. Payout levels. C. Or tax treatment. D. Beyond the standard terms of the annuity. Question 19. Which of the following annuity options offers the highest potential for payout but also comes with the highest risk? A. Fixed annuity. B. Immediate annuity. C. Variable annuity. D. Period certain annuity. Answer C. Variable annuity. Explanation: variable annuities offer the highest potential for payout because their returns are linked to the performance of the underlying investments such as stocks and bonds. However, they also carry the highest risk as the value of the annuity can fluctuate based on market performance. Fixed annuities A and immediate annuities B offer more predictable payouts but with low potential for growth. Period certain annuities D focus on guaranteed payments for a set period, not variable growth. Question 20. In which situation would an annuity with a refund option be beneficial? A. The annuitant wants guaranteed income for a set number of years. B. The annuitant is concerned about outliving their income and wants to ensure a return of their premium. C. The annuitant is planning to access the funds for a short period. D. The annuitant wants to maximize the death benefit for their beneficiaries. Answer B. The annuitant is concerned about outliving their income and wants to ensure a return of their premium. Explanation: a refund option ensures that if the annuitant dies before receiving back the total amount of premiums paid, the beneficiary will receive the difference. This option provides a measure of protection in case the annuitant outlives their income. The other options, A, C, D, do not directly align with the purpose of the refund option. Question 21. Which of the following is not a typical feature of a fixed indexed annuity? A. The annuity's returns are linked to the performance of a market index. B. The annuity provides a guaranteed minimum interest rate. C. The annuity offers protection from market losses. D. The annuity guarantees a fixed payout amount regardless of index performance. Answer D. The annuity guarantees a fixed payout amount regardless of index performance. Explanation: a fixed indexed annuity provides returns based on the performance of a market index, offering the potential for higher returns than a traditional fixed annuity while still providing protection from market losses. However, it does not guarantee a fixed payout amount regardless of index performance. The other features listed are typical of a fixed indexed annuity. Question 22 scenario. Mr. Stevens purchases an annuity with a 5-year guaranteed period. After 3 years, he passes away unexpectedly. What happens to the remaining payments? A. The insurance company will keep the remaining funds. B. The remaining payments will continue to his beneficiary for the remainder of the 5 years. C. The payments will stop after 3 years and no beneficiary will receive any further funds. D. The beneficiary will receive a lump sum of the total premium paid. Answer B. The remaining payments will continue to his beneficiary for the remainder of the 5 years. Explanation: with a guaranteed period, the payments continue for the full term of the period, in this case 5 years, even if the annuitant dies. If Mr. Stevens dies before the end of the 5-year term, his beneficiary will continue receiving payments for the remaining period. Question 23. Which of the following describes the primary purpose of an income rider on an annuity? A. To guarantee that the annuity will not lose value. B. To provide guaranteed periodic income, often for life. C. To offer tax-free growth of the annuity's value. D. To allow the annuitant to access the full value of the annuity at any time. Answer B. To provide guaranteed periodic income, often for life. Explanation: an income rider provides the annuitant with guaranteed income, often for life, regardless of the investment performance of the annuity. This is a way to secure consistent payments for the annuitant's lifetime. The other options describe features unrelated to an income rider. Question 24. Which of the following is most likely to cause the value of a variable annuity to fluctuate? A. A fixed interest rate offered by the insurer. B. The performance of underlying investments chosen by the annuitant. C. The inclusion of a cost of living adjustment rider. D. The amount of premium paid into the annuity. Answer: B. The performance of underlying investments chosen by the annuitant. Explanation: variable annuities are tied to the performance of underlying investments, such as stocks, bonds, or mutual funds. The value of the annuity can fluctuate based on the returns of these investments. A fixed interest rate, A. Cost of living rider, C. And premium amount, D. Do not directly cause the value to fluctuate in a variable annuity. Question 25. Which of the following is a disadvantage of purchasing a variable annuity? A. Predictable, guaranteed income regardless of market performance. B. A lack of flexibility in choosing investment options. C. Potential for high fees, including administrative and mortality charges. D. Guaranteed returns that exceed those of most investment products. Answer: C. Potential for high fees, including administrative and mortality charges. Explanation: variable annuities can have high fees, including administrative fees, mortality and expense charges, and investment-related costs, which can reduce overall returns. The other options, A, B, D, do not accurately describe a disadvantage of variable annuities, as these annuities involve market risk and flexibility in investment choices. Question 26. Which of the following best describes a spousal continuation option in an annuity? A. The annuitant's spouse could continue receiving payments after the annuitant's death. B. The annuitant's spouse receives a lump sum payment instead of periodic payments. C. The spouse is guaranteed a higher income payment after the annuitant's death. D. The annuity payments stop if the annuitant's spouse is still alive. Answer: 8. The annuitant's spouse could continue receiving payments after the annuitant's death. Explanation: a spousal continuation option allows the annuity payments to continue to the spouse after the annuitant's death. This ensures the surviving spouse continues to receive income from the annuity, often at the same payout level. Question 27. What is the accumulation phase of an annuity? A. The period during which annuity payments are made to the annuitant. B. The phase during which the annuitant makes premium payments into the annuity. C. The period after the annuity has matured, during which no additional payments are made. D. The time when the annuity's value is guaranteed, regardless of market performance. Answer: B. The phase during which the annuitant makes premium payments into the annuity. Explanation: the accumulation phase is the period during which the annuitant makes payments, premiums into the annuity, and the value of the annuity grows. This phase occurs before the annuity starts paying out benefits to the annuitant, which takes place during the distribution phase. Question 20. What is the primary difference between an immediate annuity and a deferred annuity? A. Immediate annuities offer guaranteed income payments right away, while deferred annuities begin payouts at a later time. B. Deferred annuities provide guaranteed income payments, while immediate annuities do not. C. Immediate annuities have no investment options, whereas deferred annuities allow for flexible investments. D. Immediate annuities are typically tax deferred, while deferred annuities are taxed immediately. Answer: A. Immediate annuities offer guaranteed income payments right away, while deferred annuities begin payouts at a later time. Explanation: an immediate annuity starts providing income payments to the annuitant immediately after purchase, while a deferred annuity accumulates funds over time before payouts begin. This is the key difference between the two types of annuities. Question 29. Which of the following best describes a fixed annuity as compared to a variable annuity? A. A fixed annuity guarantees a set interest rate and predictable payouts, while a variable annuity's payouts depend on market performance. B. A fixed annuity provides returns linked to market indices, while a variable annuity offers a guaranteed interest rate. C. A fixed annuity is suitable for short-term savings, while a variable annuity is intended for long-term retirement planning. D. A fixed annuity has no risk of loss, while a variable annuity involves guaranteed returns. Answer A. A fixed annuity guarantees a set interest rate and predictable payouts, while a variable annuity's payouts depend on market performance. Explanation. A fixed annuity provides predictable, guaranteed income based on a set interest rate, while a variable annuity's payouts are based on the performance of investments chosen by the annuitant, making them more volatile. The other options incorrectly describe the features of fixed and variable annuities. Question 30. Which of the following is typically true about the death benefit of an annuity? A. Is always equal to the total premiums paid into the annuity. B. It may be higher than the amount of premiums paid if the annuity's value has increased. C. It is paid out as a lump sum regardless of the annuity's value. D. It is paid to the annuitant's beneficiaries only if the annuitant was terminally ill. Answer B. It may be higher than the amount of premiums paid if the annuity's value has increased. Explanation. The death benefit of an annuity is typically the greater of the annuity's current value or the total premiums paid. If the annuity has grown in value due to investment performance or interest accumulation, the death benefit may exceed the premiums paid. The other options are not accurate descriptions of death benefit provisions in annuities.